Welcome to Who Said What, the show you watch so that I can keep my job. I'm Krishna, and in this show, I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. Today, I have 6 very interesting comments from last week. In the first one, I'll talk about bear markets. Ishmohit from SOIC, who's one of the sane voices in the investing space, recently shared his thoughts on how to invest in a bear market. See, the market has been on a shaky ground lately, with Indian indices down about 13% from recent peaks. While that's not quite the classic definition of a bear market, usually a 20% drop from the top, it's still painful though. More importantly, many smaller stocks are already feeling a deeper pinch. According to Ishmohit, roughly 60% of small and mid-cap stocks have fallen by over 30%, indicating we might be past a mere pullback. Adding weight to this view is a technical indicator called V-stop, which has turned negative on both weekly and monthly charts for the first time since the 2020 COVID crash.
This is a point of time कि मतलब मार्केट के अंदर जो वॉलिटिलिटी ऑन द डाउन साइड ज़्यादा बढ़ रही है. तो अगर हम मंथली चार्ट्स में देखते हैं तो वॉलिटिलिटी स्टॉप फर्स्ट टाइम ट्रिगर हुआ है ब्रॉडर निफ्टी 50 इंडेक्स के अंदर after the COVID crash.
See, you don't need to be an expert on technicals to sense the implication. The market could be entering a sustained downtrend instead of a momentary dip. Now, Ishmohit breaks down weak markets into two distinct phases. First, price correction. This is the quick, sharp drop like the 13% fall in major indices or the more dramatic 30% plunge in many smaller stocks. It tends to happen suddenly and can be shocking, but at least it's relatively fast. Second, time correction. Once prices have tumbled, the market may stop crashing, yet fail to stage a meaningful recovery. This sideways drift can last for 6 to 12 months, leaving investors frustrated and fatigued. For those who started investing after 2020, like I did, when the markets rebounded almost in a straight line, this can feel especially draining. Now there are 3 ways to handle a bear market according to Ishmohit. First, short-term traders. If you are the type who trades frequently, he advises holding more cash. Short-term rallies in a bear market can be traps, temporary bounces that lure buyers before prices slide again. Staying liquid can help you avoid getting caught at these false peaks. Second, medium-term investors. If you typically hold stocks for a year or two, consider buying in small increments during dips rather than putting all your money in at once. This way, if the market drops further, you still have cash left to deploy at even lower levels. Also, take a closer look at your existing stocks. If you are stuck with broken names that have weak fundamentals, by that I mean those that soared when optimism was high but don't actually earn much, consider switching to stronger picks. It might hurt to sell at a loss, but doing so could spare you from a worse loss later. Third, long-term investors. For investors with multi-year horizon, a bear market can be an opportunity. Think of it as a downtime to repair your nets, meaning you focus on studying companies, refining your watch list, and being patient. There's no rush to invest in everything immediately. Instead, wait for quality businesses to become reasonably priced. See, bear markets don't last forever. Being positioned in solid stocks can be very rewarding. Now he also talks about overpriced stocks. While frothy valuations, which is 80 to 100 times their earnings, were commonplace in the euphoric phases of 2020 and 2021, they can be dangerous now. As the market mood shifts, investors question whether such high valuations are justified. This skepticism often leads to harsher price drops for stocks that were banking on perfect future growth. Even if the market eventually recovers, the stars of the last bull run, like certain chemical, pharma, or tech stocks, may not be the leaders next time. Market leadership rotates, so it's worth keeping an open mind and not clinging to yesterday's success stories. Ishmohit's central message is that market's tone has changed. While we may not see a dramatic continued crash, the shift to a time correction could seriously test investors' patience.
But what we have to realize is that कि FY20 to 24 के अंदर जो used to हो गए थे returns के, maybe those type of returns will be very difficult to get going forward.
Now for the second story, I'll talk about Warren Buffett's recent letter to his shareholders. Warren Buffett's latest annual letter touched on several fascinating and in some ways provocative points about Berkshire Hathaway, its approach to capital, and its role as a major taxpayer and investor in the US economy. Although Buffett's prose is typically straightforward, there's a lot behind those lines that deserve deeper exploration. One of the most striking pieces of information comes from his discussion of Berkshire's tax payments. He notes, Berkshire last year made 4 payments to the IRS that totaled $26.8 billion. That's about 5% of what all corporate America paid. This single sentence reveals how large Berkshire's contribution to federal corporate tax revenue has become. The deeper reason behind this outsized figure is Berkshire's strategy of continually reinvesting its profits. Instead of sending most earnings back to shareholders through dividends, Berkshire channels that cash into existing subsidiaries or new acquisitions, aiming for growth that eventually boosts taxable income. Over time, those reinvestments become larger engines of profit and in turn higher tax. Buffett then shifts to a topic he has addressed for decades, the importance of a stable currency and the hazards of inflation. He warns that paper money can see its value evaporate if fiscal folly prevails. In some countries, this reckless practice has become habitual, and in our country's short history, the US has come close to the edge. At its heart, this is a reminder that no matter how profitable a company might look in numerical terms, those figures will mean little if the buying power of the dollar collapses. See, inflation erodes the real value of money. If the government spends or prints recklessly, businesses and citizens can lose wealth without a single transaction taking place, simply because each dollar purchase is less. See, Buffett's concern is that without careful management of national finances and monetary policy, the US could find itself in a situation where the currency's value is undercut, jeopardizing the stable economic environment of which Berkshire and indeed most companies depend on. Another major point Buffett addresses is Berkshire's notorious cash hoard. He clarifies that despite what commentators currently view as extraordinary cash position, at Berkshire the great majority of money remains in equities. That preference won't change. Put another way, it might seem that Berkshire is sitting on enormous piles of money, but that's not where most of its value lies. The bulk of Berkshire's assets are in businesses, whether wholly owned such as its insurance or railroad operations, or in the form of larger stakes in publicly traded giants. Around $272 billion remain invested in equities, and there is an undisclosed amount in subsidiaries not listed on the stock exchange. The cash, much of which is parked in the short-term treasury bills, is strategically held for flexibility. Buffett has often compared cash to oxygen. You hardly notice it when you have plenty of it, but if you are running low, you might face a crisis. This approach allows Berkshire to act quickly when the market takes a downturn or a great business comes up for sale. See, having significant cash available at the right moment gives Berkshire a competitive edge. But it doesn't mean that the firm has lost faith in owning productive assets. It just means it's prepared for unforeseen opportunities. Tying all these elements together, Buffett concludes with a sentiment of appreciation and caution towards the US government. He says, "So thank you, Uncle Sam, and never forget that we need you to maintain a stable currency, and that result requires both wisdom and vigilance on your part." Here, in simple terms, he expresses gratitude for the conditions that have enabled Berkshire's success, principally a strong legal and financial framework that fosters long-term investment and innovation. At the same time, he offers a clear warning that failing to safeguard the dollar's value would undermine the prosperity that companies like Berkshire have enjoyed. From his perspective, America's capitalist system, despite its flaws, offers remarkable opportunity. If inflation surges or public debt becomes unsustainable, those opportunities could shrink dramatically. See, all of these observations fit together in a broader narrative about responsibility, both corporate and governmental. Berkshire pays large sums in taxes because it continues to reinvest and grow, thereby generating ever-increasing taxable income. The government in turn collects those taxes and has a duty to manage them wisely. That management includes exercising caution with spending and monetary policy so that the purchasing power of the dollar remains stable. Now for the third story, I'll talk about China. Noah Smith, who's a well-known economics commentator, recently published a piece titled "Manufacturing is a War Now," which argues that manufacturing capability has become a central pillar of geopolitical power. Specifically, he warns that China has achieved dominance in many sectors, from batteries to drones, and that this edge isn't just an economic advantage. It could also become a military advantage. Now let me start with the main point of Noah Smith's argument. China's manufacturing supremacy didn't happen by accident. According to him, this is the result of decades of strategic industrial policy dating back to the early 2000s. Beijing identified EVs and battery technology as national priorities as far back as its 2001 5-year plan. Fast forward to today, and China now leads in the production of batteries, drones, electronics, and a wide range of sectors that have obvious military implications. He notes that manufacturing capability directly translates into military capability. He highlights the war in Ukraine as an example. Stockpiles were quickly depleted and the fight turned into a race to produce more ammunition and equipment faster. When it comes to large-scale or prolonged conflicts, the country that can build more weapons and supplies at the fastest rate usually has the upper hand. What makes his piece especially troubling is the data he lays out. First, 70 to 90% of global production across multiple battery supply chain stages is now in China's hands. Second, China is creating massive overcapacity, as high as 400%, to flood global markets and push out competition. Chinese firms have already surpassed German manufacturers in machinery exports and are quickly catching up to Japan in the automotive space. Third, according to UNIDO data, China might reach 45% of global manufacturing by 2030. That level of dominance has only been matched twice, one by Britain at the dawn of Industrial Revolution and once by the United States after World War II. His essay pairs perfectly with a Carnegie paper that narrows its focus on the battery race. While it confirms that China dominates current lithium-ion battery tech at every step, which is from mineral extraction to final assembly, the Carnegie authors also say there's still hope for the US. So the argument is the US can leapfrog by going all in on the next generation solid state batteries with lithium metal anodes. These batteries promise dramatic improvements in safety, energy density and charging speed and could power everything from 1000-mile range EVs to advanced military technologies. However, the authors warn that right now the US is investing almost entirely in current generation lithium-ion tech. Over 90% of a recent $40.9 billion manufacturing investment is going to tech we are already behind on. To change course, they suggest first, boosting R&D funding, noting that China has taken lead in battery research publications. Second, introducing targeted financial incentives to encourage scaling up those next generation batteries. Third, creating protected initial markets through government procurement so that new US companies can build momentum without being crushed by cheaper Chinese manufacturing. One aspect of Smith's piece that makes me uneasy is that the way he frames China as an enemy rather than a rival. This is where Harvard political scientist Graham Allison comes in. Allison wrote about the Thucydides trap, referring to the historical pattern where a rising power threatens to displace an established one, and in many cases that leads to war. Out of 18 such power transitions over the past 500 years, 12 ended in conflict. Now that's a daunting statistic. Examples include the tension between Britain and Germany before World War I, where economic and naval competition escalated into open warfare, and the ancient Greek rivalry between Athens and Sparta. Peaceful transitions like when the US replaced Britain as the leading power in the early 20th century usually happened between nations sharing closer cultural and political ties. So while Noah Smith's military metaphors, which is manufacturing doesn't just support war in a very real way, it's a war in and of itself, underline the urgency, they might also push us toward a dangerous mindset. If both sides feel they are in an unavoidable conflict, it could become a self-fulfilling prophecy. Competition is clearly real and China's industrial policy does aim at dominance. But how we define that competition, enemy or rival, matters. Let me know your thoughts. Is China inevitably an enemy in the manufacturing race, or is there still room for peaceful competition? Now for the fourth story, I'll talk about China again. Brad Setzer, a senior fellow at the Council of Foreign Relations, is one of the go-to persons to learn about what's happening in China. His recent New York Times op-ed, "Xi is making the world pay for China's mistake," sparked an interesting debate about China's manufacturing dominance and trade imbalances. This also connects with the points raised by Noah Smith about manufacturing competition that I just spoke about. Brad makes a striking claim. China has fundamentally distorted global trade through policies that create a heavily one-sided relationship. He backs this up with eye-opening data. Over the past 6 years, China's manufactured exports has grown more than 10 times faster than its imports. China now dominates global production across multiple sectors. It has the capacity to produce two-thirds of the world's cars, over half of the global steel and aluminium, and controlling solar cell and battery production. He argues that this dominance isn't accidental. After the 2008 financial crisis, instead of boosting consumer spending, China funneled savings into infrastructure and property, leading to a massive real estate bubble. Then when Xi Jinping cracked down on the housing sector in 2020, China compensated by ramping up its manufacturing capacity and exports. In Setzer's words, that's making the world pay for China's mistake, essentially exporting the consequences of its own economic mismanagement. But after this came the pushback. Justin, an assistant professor at the University of Cambridge, criticized Setzer's framing on Twitter. His main objection, labeling China as harming global trade, might be off the mark. He sees China's export strategy as a standard path to development, one that many successful economies have taken throughout history. Justin also points out that the countries like the US chose to run trade deficits with China. It's not as though this was forced upon them. American consumers and multinationals in many ways benefited from cheaper goods and expanded supply chains. So his message to the US, if you don't like these deficits, then simply compete rather than casting China as the villain. Now Brad responded to this. He highlighted several macroeconomic points that support his argument. First, China's 45% savings rate is extremely high compared to other countries. Second, such high savings can fuel either domestic bubbles like the China's property market or global imbalances in trade. One country's surplus necessitates another country's deficit. Not everyone can compete if someone else is controlling such a huge slice of the pie. Some Asian economies, for example Taiwan, have remained competitive by intervening in currency markets and limiting social spending, but that only shifts the problem somewhere else. The US has accommodated China's surplus through fiscal deficits, but that comes at a cost for the US economy. China's growing surplus is crowding out other economies. So it's not just a matter of US refusing to keep up. Justin did acknowledge some of these macro points, but he continued to emphasize that China's economic development is largely a success story, one that benefits many countries. He wondered if Setzer's real issue is wanting to preserve US dominance rather than moving toward a world with shared power and prosperity. Now, why does all of this debate matter? Well, it ties into Noah Smith's commentary on manufacturing competition, where he argues we could see industrial competition almost like warfare, and also links to the Carnegie report that highlights the strategic importance of battery technology. All three sources are wrestling on the same broad concern. China's rapid expansion in manufacturing could pose both economic and security challenges for other nations, but they don't all point finger in the same direction or suggest the same fixes. For example, Noah Smith talks about using industrial policy and creating common markets to counter China's rise. The Carnegie report suggests focusing on next generation technology like advanced batteries to leapfrog and stay ahead. Meanwhile, Setzer and Justin are debating the structure of the global trading system, questioning whether China's approach is an unfair distortion or just a classic development strategy. In the end, their disagreement reflects two compelling views on international economics. View 1, China's state-led industrial policy distorts fair market competition and the global trading system should step in. View 2, China is simply following through a well-worn path that many successful economies used, and it's challenging the assumption that Western economic power should remain unchallenged. Now for the fifth story. Vinay Paharia, the CIO of PGIM Mutual Fund, posted something very interesting on his LinkedIn, talking about something that affects every investor: behavioral biases. Vinay has drawn attention to an eye-opening pattern among retail investors. He found that over a 10-year period, individual investors more than doubled their stake in the worst 25% of companies, going from 9% share to almost 20%. In stark contrast, their holdings in the best 25% of companies stayed flat at around 12 to 13%. Now here's something very interesting. Those best companies generated an average return of 34% over the same decade, while the worst companies actually lost money, averaging a negative 4% return. So the very stocks retail investors kept buying more of did significantly worse over time, and the ones they barely touched went on to do remarkably well. Vinay points out that multiple classic behavioral biases could be causing this. First, anchoring bias. Investors like you and me often fixate on stocks' previous high or their initial purchase price. When the price drops, we treat it as a bargain regardless of whether the fundamentals support that notion. Second, value illusion. This is basically catching a knife. Investors see a steep price drop and mistake that drop for an actual value even if nothing else justifies it. Third, loss aversion. From Kahneman and Tversky's prospect theory, we all hate losses more than we like the gains of the same amount. It makes people cling to losing stocks longer to avoid locking in or loss. Fourth, recency bias. Placing too much weight on the recent price movements and expecting them to reverse quickly, even if the broader trend or fundamentals suggest otherwise. Fifth, confirmation bias. People hunt for evidence that supports the belief a fallen stock is bound to bounce back, ignoring any signs that it might not. All these biases combine into a very dangerous feedback loop. Retail investors like you and me see a stock tank, consider it cheap, buy more, and stay stuck in an underperforming company. Meanwhile, we miss out on the winners because they are not too anchored to hold the old price references to build up bigger positions there. Vinay's warning is crystal clear. Beware of the anchoring bias. Do not catch the falling knife. And he is not just offering anecdotal advice. His insights are backed by extensive academic research, studies by Barber and Odeon and their work on the disposition effect, plus research specific to Indian market, all show that retail investors often make decisions based on these reference points instead of genuine fundamental value. So that's the story. Even though the idea of buying low is attractive, it can turn into painful trap when we let our biases rather than solid research and fundamentals guide our decisions. Now, for the final story, I will take a close look at the big moment in AI, the launch of OpenAI's new GPT 4.5. But before that, let me give you some quick context. And let me start with NVIDIA CEO Jensen Huang, who recently issued a strong warning about AI's insatiable appetite for computing power. In a recent interview, he noted the amount of computation necessary to do that reasoning process is 100 times more than what we used to do. He's talking about how modern AI models effectively think to themselves before giving you an answer. And this has led to a massive spike in the need for computational resources. That warning seems spot on because just now OpenAI launched GPT 4.5, confirming that AI's computing requirements are truly exploding. OpenAI CEO Sam Altman made a candid admission when he announced GPT 4.5. He said, "Bad news, it is a giant expensive model. We really wanted to launch it to Plus and Pro at the same time, but we've been growing a lot and are out of GPUs. So right away, we see how these skyrocketing demands for computing power have real-world impacts. Even OpenAI doesn't have enough GPUs right now to roll out GPT 4.5 to everyone at once." OpenAI's official announcement for GPT 4.5 also points out this is no minor upgrade. It's a huge leap in unsupervised learning, making it much more compute intensive than previous models, making it more expensive and not a replacement for GPT 4. We are still unsure if we will continue offering it long term through our API due to its resource demands. This admission raises a big question for the entire AI field. How do you handle a technology so powerful and so expensive that it strains even the largest tech infrastructures? Just as these new AI models are demanding more compute firepower than ever, we are also seeing new export controls that could limit chip availability. Here enters Brad Smith, Microsoft's president. He openly warns that Biden administration export restrictions on AI chips might end up hurting American technological leadership more than helping it. In a new statement titled "The Trump Administration Can Avoid a Strategic Misstep in the AI Global Race," Smith specifically criticizes something called the AI diffusion race, which restricts exporting high-end AI chips to key US allies like India, Singapore, and Israel. His argument is these restrictions are undermining one of the most essential requirements needed for a business to succeed, namely confidence by our customers that they will be able to buy from us the AI computing capacity that they will need in the future. Smith's worry is that if US companies can't freely supply allies with advanced chips, those nations might turn to Chinese chip makers. an outcome he calls a gift to China's rapidly expanding AI sector. So if Sam Altman and Jensen Huang are both right about AI demanding ever more competition, there are several big consequences on the horizon. First, unprecedented infrastructure investment. Microsoft alone plans to spend $80 billion on AI infrastructure. More than half of that will be in the US, but because AI is truly global, building capacity worldwide is essential. Second, energy consumption challenges. If AI computing demands keep skyrocketing, who has enough power to run all these machines? It could create a competitive advantage for countries with robust and affordable energy grids. Third, supply chain pressures. See, building data centers isn't just about chips. Brad Smith points out that it also means manufacturing advanced electrical generators. Fourth, GPU shortages. Sam Altman's admission that OpenAI is literally out of GPUs underscores the crunch. As more companies roll out advanced AI models, everyone will be scrambling for limited hardware. With national security concerns on one side and the race to building cutting-edge AI on the other, policymakers are stuck in a tricky balancing act. Brad Smith proposes a middle ground approach. Keep strict standards on what types of chips can be exported, but remove quantity limits that hamper economic growth and worldwide AI development. The key takeaway is this: advanced AI models like GPT 4.5 demand so much computing power that restricting chip exports could slow AI progress everywhere, outside the countries that manufacture the most sophisticated chips. That includes some of America's closest allies, places the US normally wants to collaborate with on technology. That's all for this episode. Thank you for tuning in. ठीक है, अब तक सही था ना? ठीक है. They can be dangerous, euphoric. Now for the fourth story, I'll talk. क्या है?
Would you describe Xi Jinping as a dictator?
Xi Jinping.